Good afternoon, ladies and gentlemen. Welcome to the CT Private Equity Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and will publish responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and I'm sure the company will be most grateful for your participation. And I'd like to hand over to Fund Manager Hamish Mayer. Good afternoon.
Good afternoon, everybody. Thank you for joining this webinar. We're covering the second quarter and first half results for CT Private Equity Trust. I've got a presentation with a number of slides here, which I will take you through, and then we'll have a chance to answer questions at the end of the presentation. So we have just reported our second quarter numbers this morning. The NAV was down slightly in the second quarter, 2.1%, which means that we're down 2.3% in the first half. Now, the underlying portfolio is actually up slightly, and the negative number here is entirely a result of exchange rate movements. Sterling has been quite strong against the euro and the dollar in the first half of the year, and that has caused the value of our non-sterling investments, which is about 60% of the portfolio, to go down in sterling terms. So there's a slight drag here. This type of sort of small movement in the first half of the year is not too surprising, and I don't think it has any bearing as to how the rest of the year will pan out. If you look at some of the statistics that we've reported this morning, we've made 39.8 million of new investments in the second quarter, and we've had realizations of 15.9 million. We've also announced the new dividend, which will be paid at the end of October, which is 7.01 pence. And if you add that together with the 3 dividends already paid over the last 12 months, it gives you a yield based on the share price at the end of June, which is a little bit lower than it is now, of about 5.8%. So a pretty handsome yield. And the co-investment component of the portfolio is now 44.1%. The long-term plan is to move that to about 50%, but that will take time because it's an evolving portfolio with new things coming in as old things are realized. And I'll tell you a bit more about some of the new investments in a few minutes. So if we look at that's not that one. Yeah, look at the new investments here. In the second quarter, we've made 5 new fund investments, primaries as we call them. There's Montefiore, which is a French lower mid-market fund, mainly investing in service companies in France itself. Wise Equity 6, which is a leading mid-market buyout fund in Italy. Magnesium Capital 1, an energy transition fund, focusing on Northern Europe, a group that we know well. We've co-invested with them before. And then HG Mercury 4, which is a software and services fund managed by the well-known firm HG, who specialize in that area, but these are their smaller deals. They invest across the size scale, but we're most interested in these smaller ones. And then KKA, which is an emerging manager focusing on the lower mid-market in Germany. So these have all been added to the portfolio, and they'll gradually be drawn down over the next probably 4 years or so. And we've added 5 co-investments, which I will talk about individually in a minute. So the NAV progression over the long term, you can see it here. It's obviously on a rising trend, and we pay out a very healthy dividend. Just to remind you, the dividend policy is that we pay out 1% of the average of the last 4 NAVs each quarter. And if that calculation comes up with a number that is lower than the previous dividend, we just maintain the previous dividend. So it's a upwards only dividend policy. It's gone up this quarter because the average is going up. If the NAV were to go down, the dividend would stay at 7 0.01 pence until the average pushed it above that again. So that's a policy we've had in place for about 11 years and is designed to give our shareholders a good dividend, but also a highly predictable dividend. Share price and NAV total returns are shown here against the stock market over the entire life of the company, which is nearly 25 years. It's 24.5 years now. You can see there's a gap between the share price and NAV total return at the moment. There isn't always. I mean, in general, these returns are pretty similar, as you'd expect. But the gap between share price and NAV return is narrowing now. Discount's about 28% or so at the moment, and we're hoping to narrow that. It is generally quite wide in our sector, and our discount is actually smaller than average for our peer group, but still too wide in my view. And I think the gap between the dark and the light blue lines here is an opportunity. And you can see that in any event, we've massively outperformed the stock market, which is why you invest in private equity, because it does deliver premium returns over the long term. And this is just another way of looking at those returns on a last 12-month basis and performance over different time periods. In terms of outstanding commitments, this is just a point of information. We commit in advance to private equity funds in order to make sure that the portfolio is fully invested at any time, and we're currently at 208.9 million. Now, of that, about 25 million is to funds where the investment period has ended. So it's quite unlikely that any of that, or very little of that, will be drawn. This level of commitments is pretty average. It's 42% of net assets. The average over the last 5 years is 40%. So it's a pretty normal level of commitment. The debt has gone up a bit. We're currently at about 10% gearing. It's just gone up a little bit. I mean, we have been, only very modestly geared until recently. We think it makes sense to be geared. We think the returns that we'll make over the long term will be far in excess of the cost of borrowing, even at the current borrowing rates. And so that enhances returns to our shareholders. We have got 55 million of net debt. We have a total borrowing facility of about 115 million, so we're not even halfway utilizing that. And we're about to put in place a new facility. We're starting a discussion with the bank about renewing the facility, which in any event will expire in June next year. We've got plenty of funds available to take advantage of opportunities if they're not fully funded by realizations. This is the list of new investments we've made in 2023 to date. I'm not going to talk about every single one of them, but they are well diversified by industry area, by geography, by management group, and that has continued on right the way through. So we'll talk about some of the recent co-investments, just to give you an idea of the kind of thing we're looking at. So this first one here is GT Medical. So this is a deal led by MVM, who are healthcare specialists. So what MVM do is they try and find companies that have a technology, a service, a product that works, it's efficacious, but has not been fully commercialized, and they bring their skills to bear in doing that. And this falls into that category. So what GT Medical do is they've got a revolutionary technology which uses radioactive cesium, little bits of that embedded in this tile, a sort of bioabsorbable tile, which then gets put into the place where someone had a brain tumor removed. So if you've got brain cancer and you take the tumor out, there's a gap, and they put this little tile in, and it allows the tissue to be irradiated and very accurately to stop any regrowth or to certainly slow down any regrowth of a brain tumor. It's a very serious condition, and this technology is claimed to extend life quite significantly by slowing or stopping the recurrence of the tumor. So it's quite an exciting technology, quite breakthrough, which is gaining adoption initially in the States, and then it will be further afield. So the idea here is to make about 3 times our money over the next 4 years or so. The next one is a deal led by August Equity. This is a nursery chain, private nursery chain, so quite easy to understand. Basically, this is a rollout, building out a large chain from a small chain. The people that are leading it have already done this before, and so that's it's a replication and something that's well within their capabilities. August Equity have quite a bit of experience in this sector and in similar sectors, so it's mainly in the south of England, spreading up into the Midlands, proving to be quite a defensive area of spend. Obviously, highly regulated, and it's all about quality, and that's why we've got to be careful who we select to manage it. So we're backing some very experienced people here. Again, the plan is to make about 3 times our money over 4 years. This is a completely different company. It's called Asbury Carbons. So this is a graphite miller based in the States. So the graphite is used for quite a wide range of uses, including some quite high-tech ones linked into electric vehicles, as well as used in a whole lot of other industrial processes. This is basically, it's an old family company that has been rather undermanaged over the years, and the new lead private equity owner is Mill Rock Capital, who specialize in turning around undermanaged companies, and that's what they're doing here. They've been able to buy in at about 5.5 times EBITDA, which is a low price, and they have a plan to transform this business and improve it over the next 3 years or so. Well, 4 years actually. We expect to make about just under 3 times our money. Another August Equity investment here, StarTrack. What this company does, it provides software mainly used by the police, which allow it to catch people speeding and process their tickets efficiently. So I had a few moral qualms about investing in this, but it is a good company, and it is growing well, and it's currently used by about half the police forces in England and Wales. It's got some international clients, and that's an area they haven't really developed, but there's a lot of potential for growth. There are new extension products, if you like, happening here. They've got a new product which can spot people who are using their mobile phone, with their hands whilst driving, which is obviously illegal. So it can capture that. The existing technology can't do that, but this one can. And so there's quite a strong growth trajectory envisaged for this company. It's quite a small business, but it's growing rapidly, and we should make about 3 times our money over the next 4 years. This is another August deal, OneTouch, which is also a software company, but completely different. Essentially, it provides an app which is used in the care industry. So both the care companies and the clients and the families of clients use it. So the care companies use it to organize their rota and make sure they've got the relevant people around, and also the billing for the work that's done. And the clients and their families use it to know who's coming when, and checking care plans and things like that. Now, this is, it sounds common sense, but nobody else has actually produced a product like this before that covers both the company's needs and the client's needs in an integrated and reasonably user-friendly way. So this is an Irish company that's expanded into the UK, and it's growing quickly. So we're pretty optimistic about this one as well. The next one is Cardo Group. So this is completely different again. What this company does is it refurbishes social housing stock, making them more energy efficient, more better insulated, and putting in new kitchens and things like that that make them more energy efficient. And it started off in Wales as a young entrepreneur who has built up a substantial business already. And the plan, which is already being enacted, is to expand into England and beyond. There's a lot of public money behind this, which is earmarked for making the social housing stock much more energy efficient, and it's all ring fenced. And the councils or the social housing companies that commission it are very particular about your ability to do it properly on time, within budget, but also make sure it's is done in an energy efficient manner. So they've got a lot of experience in this, and so we think we can do quite well here. We're buying it at quite a low price, actually, very low price. It's 2.5 times EBITDA based upon the current year, where there is very strong growth. So we're optimistic of making quite a good return here, maybe as much as 4 times. And then most recent one here is Cyclomedia. So Cyclomedia is a deal led by Volpi. Volpi is a European buyout house, and Cyclomedia is based in the Netherlands. And what it does is it basically has this cars like this here with this machine on top, and it drives around an area, and it basically maps all of that area and provides a database, an accurate database of all the property in that area, which can then be used by councils and other sort of municipal bodies to calculate rateable value and council tax and things like that. So it started in Germany, in Holland, moved into Germany, is now moving into other countries, including the US. Volpi have already had it for about 5 years, but they want to hold it for another 3 or 4 years because it is going so well. So we've come in to the deal for this sort of second stage, if you like. In terms of realizations, we've had quite a few of these coming through in 2023, well spread by sector, by lead manager, by geography. And you can see the returns are pretty good. There are 1 or 2 weak ones, but there's many more that are very strong. And that flow of realizations has continued quite healthily through the year. The numbers are slightly down on last year. So if you look at the realizations compared to the stage last year, we're at about 80% of the level we were last year. But last year was the second strongest year that we've ever had, and we didn't expect that to continue entirely this year. So this is a pretty good progress in the circumstances. Lots of new drawdowns from the funds, and for the co-investments, I've talked about the co-investments, but there's plenty of other significant new deals that have been done in a wide range of different sectors, basically niche businesses. This portfolio is almost entirely composed of niche businesses which are operating in growing markets, where they have a strong market position and where they are essentially set to grow, not irrespective of the general economy, but with a very robust trend that will, ensure that we do get growth in just about every case. This is the long-term picture of drawdowns and distributions. You can see that, there is a relationship. When you get lots of distributions, you tend to also have quite strong drawdowns and vice versa. It's not surprising. They're 2 sides of the same coin. Obviously, we can control the co-investment element of this, and we can flex that up and down. And we have actually seen some very good deal flow. We've talked about some of those investments already, but that's something we can turn off and on at will. So looking at the largest underlying holdings on a look-through basis, This hasn't changed a huge amount in recent months. I mean, it does change a bit depending on the size of the holdings. I'll just give you a couple of sentences on each in terms of things to watch out for. So Sigma, hopefully we'll sell that. I think early next year probably. It's going quite well. It provides electrical components to a wide range of end uses. It's US based. Argand partners are pretty keen to sell this, and so are we. So we're pressing on with that. Coretrax is the wellbore cleanup and abandonment business. So that is trading very well. If you've read the RNS today, it has been reduced slightly in value, but that's really because the multiple of similar businesses has gone down slightly. The fundamental business here is on a good growth track, and we're pretty optimistic about this. Jolly's, the pet shop chain, is also trading very well, and I think Kester Capital, who are the lead here, will be looking at exit routes quite soon. TWMA, which processes oil rig drill cuttings, has had a slightly bumpy year where they have suffered a bit from the gas prices going down in the States, where they have quite a bit of business, leading to a bit of a reduction in activity. But the big thing for this company is they've got a large contract coming through in the UAE, which will kick in next year and which will add several £1 million to their profitability. So that is the main event there. This is going to happen. I was up in Aberdeen visiting the company recently, and I think Buckthorn, who lead this deal, will probably look to exit on the back of those contracts becoming fully fledged. Aurora, a digital payments company, that's still quite early days. That's going well. ATech is an insurance company. It provides insurance for caravans and little boats. And although the insurance sector itself has been quite volatile recently, this company has been on a growth trend. And again, I think Kester will be looking at exit routes quite soon here. San Siro is the Italian funeral homes provider. Now, last year, earlier this, was it last year or earlier this year? I can't remember. We sold most of this, and this is 25% that was rolled over into the new deal. Fun enough, in the new deal, it's actually slightly underperforming because the number of deaths in northern Italy has undershot forecasts. Now, that will be a self-correcting thing because unfortunately nobody lives forever, so there will be a bit of a catch up there, and I think the underlying investment case is still well intact. AccuVein provides as a machine that allows you to look at people's veins and arteries and be able to inject into them much more reliably than without it. And this business was held back a bit during COVID because their salespeople couldn't go to the hospitals and make the sales, but they've been able to do that. So there's quite a lot of catch up taking place now. Another healthcare one, Amethyst, is a chain of radiotherapy clinics across Europe, and that is trading quite well. Radiotherapy is being used in a much more sophisticated way than it has been historically. It can be targeted a lot more, and is generally, it's a lot cheaper to do than chemotherapy, and actually in some cases can be much more effective. So that is going well. And then Cyclomedia, that we've just talked about, has gone straight into the top 10 holdings. In terms of the split of the portfolio by geography, it's 42% in the UK. So we're probably the most UK oriented of our peer group. Most of the others have got a much smaller percentage in the UK. So we're not a pure play by any means, but we've got a significant exposure to the domestic economy. Most of the rest is in continental Europe, and there's a bit in the USA. And that provides us with a huge spread of opportunities, far beyond what we could achieve just in the UK or in any of these markets individually. By vintage year, the portfolio has got a significant maturing element. I mean, it always has, because we're always investing, and therefore there's a kind of conveyor belt of deals coming to fruition. So about 60% is more than 3 years old, 50% over 4 years old. Now, the average holding period is about 4 years. So at this point, these deals come into the frame for exit. And after about 3 years, people start planning the exit. So this is your stock of mature holdings that are coming through and providing the realizations. And realizations typically are at a significant, 35% or so premium to the last holding or carrying value, so they tend to boost NAV. In terms of the valuation, it's not particularly expensive on an underlying basis. It's about 11.6 times enterprise value to EBITDA, which is not high by the standards of our sector or peer group. And the entry price is even lower. It's about 8.7 times. If you look at our long history, which goes back nearly 25 years, I mean, the average in price is about 8 times. It's a little bit higher than average, but not much higher. And the debt is not particularly high. It's just over 3 times on a debt to EBITDA basis. So that is, that is quite modest gearing, actually. In terms of the sectoral exposure, we have quite a lot in information technology and healthcare. Combined, these two sectors account for about 45% of the portfolio. There's nothing wrong with that. That's been areas that have got secular growth and have therefore attracted interest from private equity and attracted interest from us. So these are areas that have proved very resilient in recent years, and there's a good growth trajectory, and they tend to be sold at quite good prices. We've got plenty of other exposure though in energy, business services, industrials, and consumer discretionary. So we are not overexposed to any one sector or trend. So just to conclude and talk a bit about the outlook. This portfolio has proved itself very resilient in recent years, and it's doing so again despite the high energy prices, inflation, high interest rates. These are things which the management of the companies and the management of the funds that we're invested in are having to cope with, and they're coping well. We are exposed significantly to these sectors with very clear long-term growth, information technology and healthcare, which is a good thing. And we're seeing plenty of new opportunities to invest in funds and co-investments, apart from funding investments with the proceeds of realizations. We've still got plenty of borrowing capacity should we need it. And we're seeing some good value in the lower mid-market, with pricing moderating a bit recently. It hasn't gone down very significantly, but it has softened a bit, which is good for us buying. And we are making lots of new commitments and investments on a selective basis, excuse me, which is laying the foundations for future growth in asset value. As I mentioned earlier, the exits have held up well, despite coming after 2 very strong years. We're running at about 80% of the levels achieved at this point last year. And we think that should continue about that level. Plenty of people still want to invest in private equity. The long-term appetite is there, and there's a lot of capital available to go into private companies, and we will obviously have many of them coming into our portfolio. And so we're very confident the company will continue to grow value for its shareholders over the medium and longer term, and indeed quite probably over the remainder of this year. So that is the end of the formal bit of the presentation. So I think I'll open up for questions now.
That's great. Thank you very much indeed, Hamish, for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review your questions submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Thank you to everybody for your engagement this afternoon. Peter, if I may, you can see there's been a number of questions from investors this afternoon. If I could just ask you, if possible, therefore, to read out those questions and obviously where it's appropriate to do so, and I'll pick up from you at the end.
Sure, thank you. Thank you, Hamish. Yeah, we've had quite a few questions in this afternoon. A lot of things you've touched on in the presentation, Hamish, but I will mention them just to reference the question and maybe another couple of words on some of them. But we start with a question, should we expect future NAV growth to lag the growth of the wider stock market, given the headwind of high leverage at the individual portfolio company level, coupled with the higher interest rates we're currently experiencing?
No, I don't think you should expect it to lag the stock market. I mean, the main reason for investing with us is that NAV growth tends to outpace the stock market. Now, that is despite all these things. There are occasionally patches where we don't keep up with the stock market, but they tend to be caught up because you are investing in businesses that are growing. There is debt in the capital structure, but when you've got a growing business and you've got debt which is manageable, then you will get faster growth than if you didn't have that debt. So I think, that's not to say there are no headwinds as a result of higher interest rates, but they're no more significant for these private companies than they are for quoted companies in general, I would say.
Okay, fair enough. Question on valuations. The average EV/EBITDA multiple, do you see it being stable? Has it been falling or rising? Any expectations on the future of that?
It's gone down very slightly. I think it was at 11.6. I think it was just under 12 or just about 12 recently. So it has gone down a little bit. So
no reason to expect any change in the.
Well, I mean, it might come down a little bit. That doesn't necessarily mean you're going to get a sort of soft NAV, but it might well come down a bit. I did mention that pricing generally was moderating. So that's sort of code for going down a little bit. So I wouldn't be surprised. I wouldn't be surprised if it went down a little bit from that EV to EBITDA multiple. But one of the things about that is that it means that to achieve an exit, we don't need somebody to come along and pay an unattainable price, an unrealistic price. And this is why you often see the mid-market continuing to get good turnover of their portfolios when the bigger deals, which are generally much more expensive, are harder to exit. So tend not to see that much movement at our level, but it's always a lot cheaper than the big buyouts, and hence I think much easier to achieve exits on a sort of steady basis.
Okay, thanks. You've mentioned commitments and a slight drop in realizations. Are you slowing down any commitments in the future, or is there no plans to? We're sitting on a bit of cash in the fund, aren't you? If you need it.
Well, yeah, we haven't got lots of, we haven't got net cash or net debt, but we have got lots of borrowing facilities. So basically, we've got quite a decent amount of commitments at the moment. So it's probably going to be about this level, or proportionately the same size compared to the size of the company. It's 42% of NAV, so I don't expect it to sort of burst up much above that. But the overall commitments will grow in tandem with the size of the company. Now, if they didn't do that, we would end up not deploying enough capital and end up with piles of cash, which would be pretty inefficient. So the answer is we're not particularly slowing down commitments, but we always keep a very close eye on it, and also a close eye on the balance between drawdowns and realizations. We basically forecast this all the time, because the last thing we want to happen is to run out of money by accident.
Sure. Getting a bit stock specific for the moment, GTE Medical. You mentioned that you're able to invest in the same terms as of 2 years ago. Can you explain why that came around? How that came around?
Well, yeah, no. Basically, we invested in that at the beginning of this year. So we've just put the money in.
But it was the same terms as offered to you a couple of years ago. Is that correct?
No, I don't think that's not quite sure. I mean, the deal has taken quite a long time to develop as a co-investment, but I think we're probably referring to is that MVM had already, they had already been in it for 2 years.
I see.
They had been in it already, and we were able to come in 2 years later at essentially the same price. Now, why is that? Probably because it hadn't made that much progress in the first 2 years. But from our point of view, that's a good thing. I mean, they have probably made quite a bit of fundamental progress that hasn't been reflected in the numbers, and so our holding period is going to be quite a bit shorter than the holding period for the whole of the MVM fund, which is a good thing because we will probably make a higher return. The other good thing about it is that MVM have been in the company for 2 years and they've put more money in at this price, which gives us a lot of confidence that we'll do well.
Sure. Next question is a general one. Given the broader market conditions, are you seeing a greater number of opportunities? And what are your key criteria when choosing to invest?
Yeah, we're seeing lots of opportunities. I mean, basically, the deal flow is very strong, both in terms of funds and co-investments. When we're looking at a fund, we assess lots of different variables, but we want to be sure that the fund can deliver a net return to us after all costs of about 20% per annum. And if they don't have the potential to do that, then we won't invest. Now, obviously, they don't all do that, but that's the yardstick. And at the level of a co-investment, we our minimum return expectation is 25% net IRR, which is quite high. A lot of the deals that we look at fall down because they're only offering 21 or 22%, and we don't think that gives us enough of a margin of safety. I mean, the long-term return from our co-investments, fully realized, is about 27 or 28%. So the discipline has held, and it does actually work. So these are the financial criteria, if you like. A lot of the other things are to do with the analysis of the market that the business is in and the management that is leading the company, and looking at the plan and seeing if it's realistic, seeing if there's a good match between the skills of the people that have drawn up the plan and the plan itself. They're not trying to do something that's too optimistic or too ambitious. And management is a key component. If you're not confident in the management, you won't invest. And if the deal goes wrong, it's probably gone wrong because you've misjudged management.
Fair enough. Regarding the vintages, there's a slide you referred to a bit earlier. How do you monitor the tail of older deals? I think 6% were in pre-2014. The question is, are they generally underperforming deals, or are there other reasons why you've kept hold of those investments?
Yeah. So, I mean, there is always a tail, and the 6% that's pre-2014. So that will have, these will be investments that have, they've tried to sell them and they haven't been able to sell them, but there's still value and it's still worth going on. Now, just because you hold an investment for more than 4 or 5 years doesn't mean you won't make a good return from it. I mean, we're monitoring these just as we're monitoring all the deals. Every quarter they've revalued and looked at. It's quite possible that you can make an adequate return in a deal that's been in the portfolio for a long time, but obviously you have to sell it for a higher and higher amount to maintain the same sort of a decent return. We had one investment many years ago which was in the portfolio for 21 years, and it made 35 times original investment and a 28% IRR. It was a railroad company in America, and I used to go around the shareholder base explaining about it. And to begin with, I said, well, I can't claim any credit for making the investment because although we've refinanced it a few times, when we made the original investment, I was still at university. So we sold that in 2007. Yeah, so that was a bit of an extreme example, but you're right. We just keep on top of it and make sure that whoever's responsible for the investment is focused on exiting. Most of the funds that we're in are 10-year life with the ability to extend by 3 or 4 years. Sometimes you'll get a fund that runs on to 15 or 16 years, and that's normally because there is one sort of stubborn investment that they're desperately trying to sell. And that can, apart from the tidying up the portfolio, it can be economically significant to the managers of the fund, so they can be very much incentivized to stick with it and get it done.
Mm-hmm. Going back to debt a little bit, we've got the RCF in place for the borrowing. The question is a general one: are you seeing banks still keen to lend to private equity deals? Are terms and covenants a bit tighter than they have been in the past when we had lower rates?
Yeah, terms are a bit tighter. So they are, they've tightened up a bit. It's not just banks that are lending. You've also got private debt funds, which are quite active in the sector. So these are sort of non-bank lenders who, as I say, are quite active. Terms are hardening, and availability is harder than it was, but we're not talking about a situation that's in any way similar to what happened in 2009. So this is more of a slight, a modest, tightening of credit rather than a credit crunch per se.
Mm-hmm. And the slide we've got on screen at the moment shows 42% based in the UK. A question regarding Brexit and any ongoing issues the UK may have in that regard. Is your focus to be less reliant on UK investments in the long term and maybe looking more internationally for better growth, or are you very comfortable with the exposure you've got in the UK?
No, we'll always have a large component in the UK. It's our home market. It's the largest and deepest private equity market in Europe. These other markets are far less well developed, but they are developing. They're coming on quite well. So they've got, as I said earlier, lots of opportunities in Europe that we can't find in the UK, and some vice versa. So I think the geographical balance of the portfolio will be pretty similar in the future to what it is at the moment. And as I mentioned, we are one of the few companies that give you a significant exposure to the UK economy, which is, it is a large economy. It's quite an innovative and enterprising economy. I mean, when Brexit happened, that was a bit of a shock to the portfolio. There was a big sort of triaging exercise done to see how many companies were exposed and how significant it would be for them. And it's fair to say there was a lot of work done on that. But things have progressed a lot since then. People have adjusted to the different rules and the labour market and all these sort of things. So it's not really held us back at all. I mean, it did dent us a bit in terms of the UK currency obviously went down, and although our euro-denominated assets all went up in sterling terms because of that, because we had so much in the UK, we didn't have as much euro-denominated exposure as some of our peers, so they actually benefited even more from the devaluation of sterling than we did, which is a bit annoying, but that's just what happened. I mean, generally speaking, from here, I don't really expect there to be significant changes in the exchange rate between the UK and Europe, because the economies are still so closely linked.
Fair enough. Valuations, just a brief question on valuations, and then we'll finish with another one about why you're so optimistic. Someone obviously doesn't know you very well because you're always optimistic. But firstly, you mentioned that the entry EV/EBITDA multiple has gone up slightly. I think you said from 8 to currently 8.7. The question is how they remain so stable, because the questioner has suggested that other funds have showed entry valuations that have gone up in recent years. I'm not sure if that's, I don't know the other funds well enough.
Yeah. No, well, I mean, they have gone up. I mean, our long-term average, I said, was 8 times, and it's gone up to 8.7 times. So it all depends. It depends on your own pricing discipline and the discipline of those people that you're investing with. So the mid-market buyout funds that we invest with, co-invest alongside, they're all pretty price sensitive, and so am I. I think there's a very strong inverse correlation between the price you pay and the return that you make, and I can prove that because I've done 100 co-investments in the last 20 years, and there's a very strong relationship there. I.e., you pay a lowish price, you'll get a high return. Doesn't mean it's invariably true, but the relationship is quite strong there. Some of the increase in prices that you'll have seen across the market is to do with different sectors. So the more you have in, super technology companies, things that are comparable to the kind of things that are on the NASDAQ in the US, then the more likely you will have seen creeping up in price. But the key is to get into these things before they're expensive, and then be in there whilst there is a re-rating. And most of the companies we invest in, even though our investment thesis is not based upon multiple expansion, we almost always get multiple expansion, probably about 2 turns of EBITDA through the holding period. But if you overpay in the first place, you won't get that multiple expansion.
Sure. And we'll finish here because I think we've just come up to 50 minutes. But the final question was optimistic views, and what gives you the confidence? I mean, I see you've got a decent pipeline of flow. I see your realizations that's very strong. But just to end on a positive note, and the confidence you have in the portfolio for the next year.
Yeah, because we're looking at what's going on an underlying basis in these businesses, and they're still growing quite nicely in terms of revenue and EBITDA. The valuation multiples are not out of kilter with the fundamentals of the businesses. There is plenty of appetite to buy private companies. We're going through a slightly quieter spell compared to what we've had in the last couple of years, or last 3 years actually. It's nothing wrong with that, but I'm very confident that long-term returns will be good, and indeed we may get quite likely to get improvement in values through the rest of this year, and and beyond that. We're not seeing extreme pressure on this portfolio. I mean, there are issues to deal with, but the management of the companies are tackling these things, and so this is why we've had a sort of quiet first half in terms of movement in NAV, but it doesn't mean we won't have plenty of growth and value from here on.
That's great. Well, I might just jump in at that point. Peter, thank you so much for hosting the Q&A. Hamish, thank you for your presentation and for addressing those questions. And of course, we'll make all the questions available to you post today's meeting. Hamish, I know investor feedback will be particularly important and relative to you, and I'll shortly redirect those on the call to give you their feedback. But before doing so, if I may just ask you for a few closing comments, and then, as I say, I'll redirect investors for their feedback.
Yeah, as I've already said, the portfolio has proved very resilient. It's a very well diversified portfolio. I think one of the great strengths we have is the diversification. That is deliberate because private equity is naturally a risky asset class, and the only way I know of reducing that naturally high risk down to moderate levels is by having a well diversified portfolio of good, strong investments. And it has delivered for us. This company's been going for 24.5 years, nearly 25 years, and we have very strongly outperformed not just the stock market, but a lot of our peers. And there's every reason why that shall continue. The investment case for each of the companies in the portfolio is well examined before we invest in it, and most of these cases are well intact, and therefore we should get the returns that we were looking for, or very close to them, in due course. So there's every reason to be optimistic, and we're also standing at quite a significant discount to NAV, which gives you another value opportunity. And we have a brilliant dividend, which is virtually a unique situation in our sector, a strong, predictable and upwards only dividend, and it's a good yield at the moment. So I commend the shares to all of you, and thanks very much for the attention you've shown us today.
That's great. Hamish, thank you once again for updating investors. Could I please ask investors on the call not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of CT Private Equity Trust PLC, we'd like to thank you for attending today's presentation. May I wish you all a very good afternoon.